them highlighted. What we're going to really focus on today is how to build retirement assets that someone can access income tax free. I'm fairly sure you all are pretty knowledgeable about qualified retirement plans. And if someone has a corporate retirement plan, you always want to participate to the best of your ability, particularly if they have a match. So what we're really talking a bit more today with executive bonus plans, which are called 162 plans, which is the section of the revenue code that they come from, is a way to augment someone's retirement. And as we know, many of the people that own businesses think they're going to sell their business and that's their retirement. So ideally, they're going to think about some of these things as they're getting ready to sell their business. And as we know, you should at least think about that 5 years out, 3 years out, hopefully not the day that you're hoping to sell the business. But so we're going to talk a little bit about deferred compensation plans in general. When, as many of you may recall, our inaugural meeting, I talked a little bit about split dollar plans. Split dollar retirement planning from an insurance perspective is when the company, as well as the executive, each contribute financially, as well as have mixed benefits as to who gets the policy in the end. What we're going to talk about today with these executive bonus plans is a pure benefit just for the employee from a retirement planning standpoint. So kind of the way to think about this is when you have a retirement plan, the money that we put in, qualified plans, all the money goes in on a tax-free basis, which means when we take it out in retirement, we have to pay taxes. So what these types of plans do is they provide access to the assets in an insurance policy that builds up income tax free. So how do you do this? So our bonuses that you could get if you work at a company and they had a good year and they pay a bonus, we're pretty used to those. Okay, so that's a regular bonus. So what these executive bonus plans do is they pay some or all of the bonus in the form of paying an insurance premium. And why would someone want to do that? It's to augment their retirement income as well as build an asset that's income tax free. And if we think about, take a firm where there's 6 employees. It could be any size firm. Public companies, this doesn't work at, so these are for private businesses. But for, let's pretend we have a company with 6 employees. There are 3 executives that are owners, and then 3 people that are more administrative. So if they have a qualified plan, perhaps the 3 owners are not able to contribute as much as they would like to because of discrimination testing. So they're looking for additional ways to save for retirement. And so back to how these plans work, the section 162, it'd be funded by the employer. So the employer decides that they're going to figure out that the 3 people that are executives and owners, they'd like to have a plan. You could do this for one person. You could do it for any number of people. It just needs to be decided who's going to be covered. You could add to the plan as it goes on. But the best practice to do this is to actually have a board meeting and decide you're going to do this. And so we're going to have our board meeting. We're going to have 3 executives that are going to be covered. And the next thing that we're going to decide is, okay, is it going to be a single bonus plan or a double bonus plan? In a single bonus plan, we're going to use the example in this case study of $20,000 a year. We're going to decide that the $20,000 that the employee is going to receive for their bonus in the form of an insurance premium payment made by the company, okay, that's taxable income, just like a normal bonus would be. So that's a single bonus plan. If we decide to have a double bonus plan, we're going to give the $20,000 plus another $6,000 based on the fact that the company's in a certain tax bracket and the employee's in a certain tax bracket to cover the taxes. So single bonus, the employee is going to be responsible for paying the taxes on it because it's the bonus that they received, even though it was in the form of an insurance premium as opposed to cash. And then a double bonus is the company grosses that up to cover the taxes. So that's the specifics about how a plan could work in general. And then we're going to go now through an example, and we're going to have a 45-year-old female And we're going to, in the insurance land, you have a health rating to figure out what your benefits are going to be. And we're going to make our employee be on preferred non-tobacco person. She's 45 years old, and we're going to decide that she's going to get this premium payment for 20 years. I should highlight that you can't just decide you want to have this plan for 1 year, take it away the next year, put it back the next. It has to be a real plan from the standpoint, this is what you're expected to do. If the company has a bad year, you don't necessarily have to fund it, but it can't be that you do it 1 year, not 1 year, so there needs to be consistency because it is a real plan from that standpoint. So the company in this case is, we're going to have a double bonus because we like those the most, because the taxes are paid for the employee. And so the next thing we're going to really do is decide that what kind of a product they're going to buy. I'm going to presume most people are comfortable with insurance. We have term that doesn't have any value that it accumulates. Whole life, on the other hand, is designed that it's an asset that accumulates over time, and presume for argument's sake, it returns roughly 5%. So that 5% that's in the whole life policy grows on an income tax-free basis, and you, the owner of the policy, are able to access that. So we've got our 20 years of, in this case, $26,000 going in. The premium is going to be the 20, the 6,000 is covering the tax. And how this works is you have an initial death benefit of about $450,000. That's day one. Pay for the 20 years. And by retirement, that death benefit is growing. And what we, for this retirement plan that we're set this up for, are really focused on is how much cash value could we take out in our retirement years. So I built this example that we're going to take retirement income for 15 years. So if it's a whole life policy, that's the most conservative type of product. It comes with guarantees. Someone would be able to take out roughly $55,000 a year for 15 years. So the money that went in, the $20,000 for 20 years, $400,000, is able to reap a benefit of income tax-free assets of $225,000. Okay, if it's an investment in the market, it should have a better return. However, you have to pay taxes. So you really want to look at what the tax, this is an asset diversification as well as a tax diversification strategy. Right, so that example was with whole life. Another product that can get used for retirement planning is something called Index Universal Life. And what Index Universal Life does is it's based on the performance of a certain index. And in this case, it's going to be the S&P 500. I presume returns of 5.5%, which should be on the conservative side. I can go into more details about how these policies work, but kind of for high level, you can build a policy in two different ways for Index Universal Life. You can have a level death benefit. That means the death benefit never increases. It's a more conservative type policy. So this person's going to have an initial death benefit of over $1 million, and they're going to be able to take out $62,000 a year. So they're getting close to $934,000 in their retirement years. That's 15 years of taking it out. Or you could have an increasing death benefit. So you'd start out with a lower death benefit. And in this case, it's about $380,000, but you could actually take out more retirement income. And the reason for that is that there is not as much of your premium going towards the death benefit because it's increasing over time versus the other one started at $1 million. So that's a little technical on how insurance works for Index Universal Lives. The next page is just details, disclaimers, and things like that. But I think the high level that I'm trying to highlight is that by someone taking a percentage of their bonus or all of their bonus that the company is paying, which again is deductible for the company because it's reasonable compensation. And if they decide to access that to set up an insurance policy, they're going to be able to access the cash value that builds up inside the policy in their retirement years. And whole life, we're saying that for our $400,000 that goes into this type of a policy, someone's going to be able to take out close to over $800,000 with a lot of guarantees. And if you're going to base it more on how markets return, you could take out over $900,000 on an income tax-free basis. So I think when it comes to business owners, the things for us to think about is if they're looking for more retirement assets or how they may want to sell their business on a more tax advantage basis, having a plan like this in place can be very helpful to augment their assets, because the cash can be accessed income tax free. And if they were to pass away, the death benefits inherited income tax free. And as I mentioned, a lot of people don't do as much retirement planning, or they're looking for more assets to be able to add. What Tom's going through right now is how a policy actually works in more detail, which I can spend time on that if you'd like, but I think it's more really conceptually the concept of how to help someone for retirement income on a tax efficient basis. And let's go to when they sell their business. So if this 45-year-old female 10 years from now decides she's going to sell this business, she could still have some sort of a relationship with a company where they're going to pay her this bonus to keep her retirement planning going. So it can be a part of a plan to exit as well as an ongoing benefit. And that concludes my more formal remarks, and I'd be happy to take any